Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I am Paul Winkler and here to talk about money and investing. I'd do something interesting this hour. So once in a while, I like to just get a feel of the pulse of just investors and send out polls and just ask questions. What are you guys thinking about? What's on your mind? And we did that recently, and I thought that would really make a fun little radio segment. So I'm going to do that. I'm going to talk a little bit about what's on the mind of people out there, just, throwing out comments and questions. And you didn't get a ton of people. They're just like, this is something that's burning. This is something that I'm wondering about and I'm thinking about, and I just want to just throw it out there. And I love answering those types of questions. So, we're putting money away for retirement. You have two stages of life. You work for money and then money works for you. And a lot of times people just aren't terribly confident in the second half of life. That is a scary thing. It's a scary prospect saying, I am going to just rely on the money I set aside for the future, and I'm going to live out my life on that. It's easy to get up and go to work every day and get a paycheck in return. I say it's easy, but it's easier not to worry about that because we don't necessarily think about the fact that we might be disabled. We might not live as long as we think we're going to live, and then our family will be stuck with not having a paycheck for themselves and won't be able to take care of that. So that's why we have life insurance, right? Well, we can take care of those things. We can have life insurance. We can have disability insurance that continues the paycheck if we're not able to work. Now, when it comes to retirement, you go, well, what takes the place of that? Well, pensions used to take the place of that. It used to be a thing where you got a paycheck for life. Now, pensions are still a thing, but what is not as normal as it used to be is a pension that has cost of living increases. And I've done that on the show here before where I talk a little bit about when we look at, what does it take to live today versus, just a little over 20 years ago. And it's almost double. The cost of living has almost doubled. Now, in some periods in history, it's even faster than that. I did a little thing where I was talking about that the cost of living in the previous 25-year period, as I recall, it was like quadrupled. So if you're living off of a pension and you're going, hey, I've got more life at the end of this retirement. I'm not quite gone yet. And you're finding that the costs are going up around you, it can get a little bit nerve-wracking and a little bit scary. So pensions used to be the way that we insured against that when they had COLAs or cost of living allowances attached to them. But it's just not the case anymore. Companies can't afford to do that. Now, governments, you have that in some governments, but even then it doesn't usually cover your entire paycheck in retirement. Now, that's one of the beauties of Social Security. That's why often we'll talk about delaying Social Security. You delay it. Why? Because it's a bigger paycheck, but also it's a paycheck that has a cost of living increase in it. And it's always been based on the labor inflation rate, which is a higher inflation rate than the regular CPI. So what happens? How do we actually make up the difference? And it's investing. And you go, well, so when we invest, it's a little bit nerve-wracking because how do we invest? What do we do? And that's why this show is so integral, I think, to the education of investors generally, but especially our clients. We do a lot of educating on investing because it's a nerve-wracking thing. If I don't understand something, it can be a source of fear. So when we look at what people's concerns are, what are they? Well, one of them is not having enough money, right? I'm not going to have enough to make it all the way through retirement. And how do we insure against that? How do we make sure, well, number one, we have our savings, we hope it's enough, but how do we invest it? How do I have confidence? As a matter of fact, that was one person's comment. Said, I want to make sure that I have confidence in investing. And how do you have confidence? Well, how do you have confidence in anything? Think about, let's say, whatever you did for a living, or if you're still working, what you do for a living. How do you have confidence you're not going to be let go or you're not going to be fired? I mean, maybe do your job would be one, but one would be making sure that you're keeping up on the current technology, you're keeping up on the information in your industry, that you're not going to be obsolete. And you understand what it is that you do. You understand the rigors of the job and the knowledge that's behind it. It's the same thing with investing. You think about it, if I understand a little bit, what am I doing? What am I investing in? How am I investing? What's the research behind it? Where'd the research come from? Was it biased? Was the information coming from, and I often talk about how so much of the information we get about investing is coming from people selling us stuff. It's coming from mutual fund companies. And it's coming from, maybe CEOs of companies that, they would love for you to buy the stock in their company. And that's a direct bias. Now, one of the things that we have to be very wary of is we may be actually subject to bias without necessarily recognizing it. And what I mean by that is think about how you would go about buying a mutual fund, or how you would go about buying an ETF, an exchange-traded fund, or how you'd go about any kind of investing. Typically, you're going to go out there and you're listening to people, what they're talking about. What's going on? What's hot right now? What's really happening right now? What's the future look like it's going to be holding? Oh, AI is a big deal now. Should we be focusing more on those types of companies? What areas in the market are doing well, quote unquote? And I always have to correct people. No, it's what's done well. Whenever you're hearing about something, hey, this is doing well, you have to put that in past tense. It's in the past. It did well in the past. It's not necessarily what's going to do well going forward. So what fund manager, what investment manager, what mutual fund company has had decent performance? Who is, making the headlines? Who are people talking about? Again, you're looking at past performance. Now, because past performance is a really great sales tool, I mean, it's easy to get people to buy on and jump in if something has done well because they perceive that it will continue to do well. Now, you may have heard me say that before, but that is the criteria that is often used to get people to invest. Now, sometimes fund companies, all they focus on are costs. We got the lowest, management fees. And, what you don't recognize is that's not the sum total of all the expenses. That's just the explicit expenses. A lot of times these fund companies that have super low visible management fees actually have very high internal costs. And, since the financial media and a lot of people in the investing world don't pay that close attention to anything else, they don't pay attention to bid offer spread costs. They don't pay attention to securities lending. They don't pay attention to block trading. They don't pay attention to the costs of design, talking about market cap weighting of mutual funds and those things that sometimes I get nerdy and I talk about here on the show. Since they don't focus on any of those things, it passes. It's in the example I always use because people relate to it is the idea that food companies said, take the fat out of food and you won't get fat anymore. I mean, it sounds good, right? If you take the fat out of food, it's going to reduce the calories and you won't get fat, and it won't go from the fat that you took in to your body, right? And that sounds like it makes sense. Just like, just lower the management fee. And I'm saying that particular instance, not because, high management fees are a good thing. They're not. But I'm just saying that it is oversimplified. And it is oversimplified to just say, hey, take the fat out of food. And there are all kinds of myths like that that go on and they're perpetuated because they sell. It sounds good. It sounds like it makes sense. Like, for example, I'll give you an example from the economics world. How about this one? Hadn't thought about this before, but think about this. If you would just raise taxes, you'll increase revenue. I mean, that makes sense, doesn't it? If you just raise taxes on everybody, you're going to increase revenue. There's none other than Art Laffer that basically said, no. Reagan's economic advisor says, no. If you will lower taxes, you will raise revenue because you're going to actually increase economic activity. Now, lo and behold, something that seemed totally opposite ended up being completely right. So let's say if I'm looking at just expenses, let me just use this as an example. What area of the market would have the lowest expenses as far as managing a portfolio? What's the lowest cost area of the market to manage? Well, it would be U.S. large growth companies, no question about it. Now, what would be a more expensive area of investment markets to manage? What would be more costly to manage? There's a little bit more challenge to it, and there's more to do. Well, that would be emerging markets, right? Emerging markets, small companies, especially maybe emerging market value companies would be more expensive to manage because there is some effort that is involved in, buying those companies and hanging and putting them into an investment portfolio, and the logistics are more challenging. International small companies, that would be another area. Well, if we look, or small companies in general, U.S. small caps in general, there's just more to it. There's more management that has to take place. Now, if expenses were the only thing that we had to deal with, which area would have the highest return? Well, because it has the lowest expense, large U.S. growth companies would have, historically, that should be the highest returning because it would have the lowest expenses. Like I said, it's an easier area of the market to manage. And the opposite is actually true. If we look through history, we would see that of all of those areas that I mentioned, the lowest long-term returning area of the market would be large U.S. stocks, which would have the lowest expense ratio. So you see that it's just not always as simple as it sounds. Now, the other thing that we find is that, when you're putting an investment portfolio together, there are mechanics that have to take place. There are things that have to take place when you manage a portfolio, rebalancing of the portfolio, bringing it back into balance, taking areas of the market that are overrepresented and either selling those off or just not adding to them, and then taking areas that are underrepresented and, buying more of that just to make sure the portfolio remains in balance. And the thing I talked about a little bit earlier, when you're doing the management of the portfolio and utilizing the factor of momentum or the factor of profitability in the management of a portfolio, which I don't talk about a whole lot here because it's pretty arcane. But the idea is that when you're engaging and using these things, you can actually offset expenses and really help the return of the portfolio. But, it's not something that people understand, so they don't focus on. So back to my original point is, how do I get confidence? And sometimes it's just starting to understand a few of these things and starting to learn a little bit more about it. And often when I'm teaching, I go, I don't expect you to get everything I'm saying, but little by little, the more you listen to what I'm teaching and the more you go, wow, okay, that makes sense. That ties in with what I believe. For example, when I talk about diversification, owning things that move into similar fashion. Oh, that makes sense. Bathing suit sales and winter coat sales, they don't move together. When I have bathing suit sales and suntan oil sales, they move more together. I can see visually, because you've compared it, Paul, to something that I already understand. I can see where that would make sense to invest in that particular manner. I often talk about how the media, the financial media, and even big investment firms, a huge investment firm, here locally, they actually, on their reports, they were comparing their investment portfolios and they were benchmarking their portfolios to the Dow, the NASDAQ, and the S&P 500. And that's typically what you hear reported on out in the media, right? The Dow, NASDAQ, and S&P 500. Large U.S. stocks, large U.S. stocks, large U.S. stocks. And it's like, that's goofy. And when you start to get that that's goofy and you start to look at it from that standpoint, what is the S&P 500, the 500 biggest companies? What's the Dow? 30 companies. And it's a subset of those large U.S. companies. What's the NASDAQ? It's a trading platform. It's a little bit tech heavy. So will they be exactly the same? No, because there are different amounts of companies in them and slightly different character. But in general, they are large U.S. companies. So they're going to move together. They're going to move in tandem to a great extent. So I start to get that. I start to understand, there are different segments of the market. and they don't move together. There are different types of companies that do well in different economies. And when I start to understand that energy companies may do well at a different point in time than, let's say, technology companies, and they may do better in different periods of time than healthcare companies or consumer durable companies or consumer staples, or, there are different types or defense contractors or different types of companies may do well in different periods of time. And the more I start to learn about this, the more I develop a confidence that, oh gosh, this is something I'm not throwing my brain away, and this makes some sense. And then the other thing that you find is that the more you learn a little bit about where returns really come from, what is it when I think about the stock markets, as I was talking about before, we think of it as a gambling casino sometimes because we don't necessarily think about the fact that we just own companies. I own a company. Now, I can gamble by buying and selling the companies or trading in and out of the market. But when I just own a company, that company is there doing the same thing I would do, which is when things are good and everything's going well, I don't have to worry about my expenses as much. But when things are going poorly, I have to drop my expenses to make sure that I have enough money coming in, earnings. That would be the case with the company earnings, that I have enough money coming in that I'm going to make it. And recognize that companies are run by people that are just as rational as you and I. If a company's sales come down, all of a sudden, like you lose your job, your earnings come down, you're going to go, oh, what do I have to do? Well, if I'm rational, I'm going to reduce my expenses. And that's exactly what companies do. And you own companies that are doing these things. So this is really, really critical to understand that it's not, when you own companies, you own stocks, you own things that are run by people that have the incentive to make sure that they're profitable and that they deliver a profit. Now, where does that come into getting confidence in your investment strategy and retirement income? Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right. I'm back here on the Investor Coaching Show. So I was just talking a little bit about how do we become confident? Because as I said, I like getting a little survey every once in a while and just seeing what people are thinking about regarding investing in markets and things like that. And we sent one out and got some really interesting responses. But, a couple of times we got that, just being confident. I just want to be confident in my investments. I want to be confident in my income. Of course, everybody talks about not running out of money, and that's going to be all part of it as well. So how do we get that confidence? Well, number one, education. That's why the radio show. That's why the videos that we do. That's why the initial workshops that we actually teach. And I always tell people, go back and revisit some of those workshops. You have available, it's all available out there. And the funny thing, here's the deal. This is something to be confident about. For 27 years, I have been teaching a workshop on the myths of investing and the research on investing and, the evidence-based research on investing, how the media misleads people, where returns come from in markets, how to measure, those returns, the return expectations, the different factors of investing. Here's a cool thing. You ready? Haven't had to change the workshop other than just the return data year by year and maybe the examples from the media. I haven't had to change the workshop in 27 years. Wrote my first book on investing in 2007. I've updated it multiple times since 2007, but only updated the data and a couple of the examples. Didn't have to change the philosophy at all. Now that ought to be something that's confidence boosting, that you don't have to, go, hey, what Paul think? What's he think now is the right way to invest? But you hear that all the time in the media. You need to change this. You need to change that. And, right now, based on this, that would make me crazy having to do that. Now, what's another thing that ought to be a little bit confidence boosting? Well, there's this thing called the Prudent Investor Rule. It was written by the American Law Institute, and it's a guide and it literally says in there, this is a guide for practitioners. It says the restatement is a guide for practitioners of law, trustees, and investment advisors, as well as a source of legal authority. And it says it is to be recognized that trust law is most often applied in daily trust practice as distinct from litigation concerning trust administration. So if let's say that you are a beneficiary of a trust and you have a trustee, and that trustee is managing an investment portfolio and they have a fiduciary responsibility to you. They have to do what's in your best interest. Well, this is a guide. This is a guide to help them figure it out. Now, what does it actually say? Now, there's enough wiggle room in this particular rule that it bugs me a little bit that they give so much wiggle room. But I want to read a couple things that are in here that I think you'd find really interesting, because this is part of what the rule says. It talks about active strategies. Now, does it say you absolutely can't use active strategies? No. Because if you know anything about this radio show, one of the things I've done for 25 years on this show is point out how most of the investment management out there by the big investment firms and by advisors is of an active nature. Maybe they're owning ETFs. Maybe they are owning index funds. They're doing that, but how are they managing them? And it is typically what they're doing is what's called tactical asset allocation, which is a subtle form of market timing. Where you're moving a little bit more money into this area, and a little bit more money into that area. You're moving things around. People don't even perceive that it's happening. Or there's just plain active management, active stock selection, stock picking. As I often talk about, a lot of times what investment managers will do is buy individual stocks, and they'll trade them just like mutual funds. And you go, well, it never worked for the mutual fund world. Why do you think it's going to work for you? Why are you doing that? That seems a little bit irrational. And when you read the Prudent Investor Rule, it says, no, don't do it. Then you go a little bit further in the Prudent Investment Rule. It says market efficiency. It says, economic evidence shows that from a typical investment perspective, the capital markets of this country are highly efficient in a sense that available information is rapidly digested and reflected in market prices of securities. Watch the TV when they're interviewing the mutual fund managers, when they're interviewing investment managers, when they're interviewing the big asset management firms. What are they trying to get out of them? What area of the market are you focused on right now? What do you think is going to do? What is going to be the result of AI? What's going to be what they're trying to do is they're trying to find where things are mispriced, where they could have opportunity, quote unquote. What is this saying right here? This is saying that news is driving things. It's saying that news causes things to go up and go down, and thereby any effort, literally it says it right there, any effort to apply expertise, investigation, and diligence in efforts to beat the market in these publicly traded securities ordinarily promises little or no payoff, or even a negative payoff. after taking into account research and transaction costs. So basically what they're saying right here is most of the stuff that people do when managing a portfolio from day to day. So how do we get confident? We don't do this. This is part of what we want to avoid. And the reality of it is most people are doing it without even knowing that that's what's going on. So what else can we do? Well, we can reduce risk. And Prudent Investor Rule talks about what it takes to reduce risk of an investment portfolio. So that, I think, is really critical. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.